Hello and welcome to your weekly episode of the GoNoGo Charts show. I'm joined here today by Alex Cole. How are you, my friend?
Doing well, thanks. How are you, sir?
Yeah, doing well. Markets ended a little heavier than we thought. Today we are recording this after the close. Apologies to all of our viewers. But let's dive right into the charts, Alex. Starting with the GoNoGo cross-asset heat map. Let's do our top-down perspective on where we're at in the markets today.
Yeah, so like you said, we've had a worse finish to the day than perhaps we thought earlier on as the markets were trading. But you can see that we're still in a no-go trend. We tried to rally over the course of the last sort of week to 10 days. We had a heavy down day yesterday, which seems to have maybe been confirmed a little bit today with that movement back lower and closing near yesterday's close. And you can see that in the top panel where we're in a no-go trend. They are weaker pink bars, but still a no-go for equities. Treasury bond prices is the second panel. You can see how that's turned to a go trend. We're seeing weaker aqua bars, commodities still in a no-go, and the dollar for the first time painting a weak no-go bar.
Absolutely. Let's take a look at the S&P 500, Alex. I want to do this across multiple time frames. Let's start with, we've got the daily view up. Obviously, we talked about yesterday's wait after Chairman Jerome Powell gave his FOMC press conference, 25 basis point hike. Certainly not unsurprising. A lot of analysts sort of seeing that as the middle of the road response after the collapse of Silicon Valley Bank and Signature Bank just last weekend. Lot of emphasis around the strength and resilience of the banking sector, trying to allay fears and stay on course in the fight against inflation. But if we're taking a look at the equities markets, just the US equities index level, let's jump this out to a weekly chart, Alex. And herein lies I think the central idea behind what we need to observe as market participants. And that is that trends can move in three directions. It is not a binary of either an uptrend or a downtrend, but in fact, markets can remain range bound and sideways for some time. I know one of the CMT Association board members, John Kolovos, refers to that as the technical torture chamber. For a lot of trend followers, this whipsaw action can be very harmful to strategies that rely on consistent, durable trends. What it means for investors right now is that we need to be thinking about shortening our time frames, perhaps changing our position sizing until there is a more clear resolution. But what this chart is showing us is that on the weekly basis, on a longer time frame, we have a lot of supportive or constructive evidence to the go trend. We have a series of higher lows since that deep October dip, but we're waiting a little further confirmation from the daily time frames that this new go trend can sustain, or that the secular bull market remains intact. So Alex, let's turn to a couple of our macro indicators. Let's take a look at the TNX. You talked about Treasury bond buying, right? The prices are rising, which means that the yields are coming off lower. Talk to us about what we're seeing on this chart right now.
Yeah, I mean, we've seen this correction. We thought we were in a period of rising rates again with the strong blue go bars, but then this quick fall through amber go fish into no-go colors. What we can see jumping off the chart here is that there's a lot of support at this level. You can see there's been support several times across the time frame of this chart. So we'll be very interested to see if we find support here again. But right now, no-go bars oscillate in negative territory.
Absolutely, and so certainly we want to pay attention to these macro forces. Rates certainly rolling over, right? The yields are coming down, but not precipitously lower. And I think the weight of the evidence is that we could remain at these elevated levels, perhaps not moving substantially higher, but also not moving substantially lower. And I think that echoes from a technical view, sort of what Chairman Powell was saying yesterday, that they need to wait and see how the effects of lower liquidity are going to affect home buying, car buying, the access to capital for both businesses and homeowners in the U.S. could have a similar effect to Fed rate hikes. So the Fed funds terminal rate target for the year end 5.1%, and we're going to be watching these yields each week here on the GoNoGo show and how they impact equities.
Absolutely.
So Alex, let's turn our eye to the U.S. dollar. Perhaps some more interesting action there. support to risk assets generally, as the strength in the US dollar that was resuming over the last month or so seems to have rolled over.
Yeah, this is very interesting because obviously equity markets have struggled to get out of the no-go trend, but there are some factors that might be providing some relief. That, specifically Treasury rates going back into a no-go trend, and now even the dollar as well. So early days, but a no-go on the dollar, painting pink no-go bars. And you can see how the oscillator tipped us off to that by breaking below zero ahead of the color change and then retesting before getting turned back into negative territory. So we'll be looking to see now if this new no-go will take us down to test the lows from February.
I think it's a great example. Forget the ticker symbol. This could be any security, any stock, any commodity. When we see a go trend that has consolidated or corrected, and we move to those weaker trend conditions, as we did here in March on the US dollar, our eyes immediately go to the GoNoGo oscillator. And that first signal of divergence from momentum is that we had enthusiastic selling, right? Heavy volume, negative momentum. And that return to the zero line, the retest, was really further evidence that confirming this no-go trend as it resumed in the US dollar. Interesting, the volume has dried up. Obviously, we're using UUP, which is an ETF, as a proxy for the dollar index, so we can get a view on volume trading on this as well. Brilliant. Alex, let's take a look at gold, the corollary to the US dollar.
Yeah, look at that. We spotted this, and we were talking about this at the end of last week. Gold breaking out two new highs. Again, using the oscillator to give us that warning, having entered a no-go trend, but failing to stay below zero. And this is the opposite now applying. We are in a no-go trend, so there shouldn't be any enthusiastic buying, right? That's the opposite scenario. And so when we see the oscillator break back into positive territory on heavy volume, then that is certainly a concern for the no-go trend. And that leads to 3 or 4 amber go fish bars as we run up against what could have been resistance from prior highs. And then we break through it, and we found support then. This is sort of all of technical analysis almost in one chart. Yes. Break through these prior highs, quickly retest, find support now at the gap. And then we've moved higher to new highs today.
On that strong go trend. I do see heavy volume, and we reached that overbought extreme, saw the counter trend correction icon, but have remained in elevated positive territory in momentum for gold. Alex, could you take a look at this gold chart just on a weekly or even a monthly basis to get a longer term perspective on where we might be headed? A lot of commentary over the last 18 months about commodities generally. And we looked at the US commodity index in that heat map at the beginning of today's show. Certainly, commodities have not performed in the way that historical corollaries would tell us. In that inflationary environment, we tend to see commodities outperform. That really hasn't been the case. We've seen nat gas and oil roll over. We're going to check on those in just a minute. But in terms of precious metals as a safe haven asset or a store of value during high inflation times, gold really hasn't performed that heavily. We are in a go trend, but we've been range bound and sideways for years.
Yeah, this is almost 3 years.
Right.
Yeah.
And so keeping that in perspective, right, the trend continuation sort of pattern recognition that we could see in a flag being stuck in this channel, but until we see evidence of that breaking out above those prior highs, certainly doesn't seem that this trend has a lot of steam behind it.
Yeah,
absolutely.
Yeah.
Let's move over to U.S. oil and take a look at what's happening in the energy space. Yeah, monthly charts. I love monthly charts.
Too slow for most folks.
Yes.
But yeah, this is the weekly chart that we've been looking at in really most of our shows and our research going out, because this is the one where the trend is identifiable. And you can see how we were slowly moving lower. Last week, it really took us to new depths, right? We see that last week's bar helped us close at new lows. We got turned away from the zero line again, having sort of really struggled to move away from zero for several weeks. And then on heavy volume, we moved lower as we broke below those levels. So we are still in that downward sloping trend. You can see it in the no-go bars strengthening back to purple colors, but we have made new lows. We've rallied a little bit this week, but this is a no-go trend, oscillator in negative territory.
Absolutely. And let's check in on one more asset class. If you wouldn't mind, pull up that crypto rel map that shows the trends of a few of the top holdings in the cryptocurrency space by market cap, just to see what's been happening under the hood there in the digital asset space.
Yeah, let's get US oil out of the top. That won't make a whole lot of sense.
So these are all relative to the S&P 500,
Yep.
the top cryptocurrencies by market cap, Bitcoin, Ethereum, Cardano, and Ripple, correct?
Yep.
In that lower panel?
Yeah.
Tell us what you're seeing in terms of rotation here, Alex.
Yeah, you can see the relative outperformance of these cryptocurrencies now for a couple of months. There was a little bit of a struggle here, and your risk management may well have got you out of this move in cryptos. But then the beauty of being a technician is that you should be able to get back in if you're told to and follow your process in both directions. And so that relative outperformance has returned. You can see here a couple of bars ahead of the pure go trend in Bitcoin. We went into a relative go trend versus the S&P, and that's the same with Ethereum, just one bar earlier. Cardano is not doing as well just yet, but has moved into neutral territory on a relative basis, and Ripple has entered a new go trend as well. So cryptocurrencies are relatively outperforming again versus the US equity markets.
Absolutely. I think that's perhaps one of the most salient points for users of technical analysis, and that is you don't have to understand all of the underlying lower level protocols or the utility of blockchain. You don't have to be an expert in the technology to still take part as an investor because our price analysis works across all asset classes and all timeframes. And then, Alex, one more sort of macro chart before we move on. Let's look at the global equity rel map just to see what other country level indices are doing relative to the US equity sector. And really where this gets into play is considering the construction of the US index, right?
Yeah.
We're very heavy into technology, long duration securities, what has been a steady outperformer for over a decade. But what the macro analysts are looking at is that potential return to more cyclically dominated equity indices. So UK, Eurozone, some of the emerging markets that have a stronger tie to commodities and materials. From this map, Alex, it looks like outside of Singapore, everything is underperforming the S&P 500.
It was interesting for a while because we did see some really good outperformance across the map here in terms of different countries to the S&P. But you can see how it has rolled back over, and now we are outperforming domestically versus the rest of the world in terms of the countries on this map. So when you're looking at this map, all of these no-goes are showing us that the rest of the world is underperforming US equities. Now, we've got a few amber neutral bars here, but you can see the general makeup of this map, like you said, with the exception of Singapore, everything underperforming relative to the US.
Absolutely. US investors being compensated for their home bias. But we keep an eye on these things because at any time the rotation could move leadership to foreign countries, and in this environment where we can invest basically without friction through ETFs and get exposure globally, it's important to keep that in mind. All right, Alex, let's go back to the S&P 500 and let's get under the hood and take a look at our sector rel map. And this is going to break down each of the equity sectors of the S&P 500 relative to the benchmark index. And what we're doing here is trying to take that top-down analysis to isolate the leadership within the sector groups to help us find opportunities for those long trades. Talk to us about what's on this rel map. It's a rather confusing picture, Alex.
Yeah, we were talking earlier with some clients, and the interesting thing here is that we've got strong relative outperformance in technology, and that's been persistent. And we've been looking deeper into technology and finding some outperformance in subsectors such as semiconductors and others. But you can see strong outperformance in technology, which has been the case for a little while. a return to outperformance in communications. Okay, so those are our growth sectors. But then we've also got strong relative outperformance here, which is the consumer staples sector. And we even had utilities trying to break into relative outperformance. So we've got a bit of extremes going on here with some growth and some defense. So very interesting map.
Absolutely. So let's take it a step lower. Let's pull up the industry groups of the technology sector of the S&P 500. And so what we're doing is same exercise. We're going to look at a relative ratio of each of the industry groups relative to the technology sector.
Yep.
And as you mentioned, semiconductors have been a consistent outperformer leadership group within the technology sector. Other industry groups that are popping out to you, Alex?
Yeah, that's I mean, that's been the main one, and we've also got a couple of others. As you said, we're seeing the top half of this map starting to dominate in terms of outperformance. In terms of sort of consistent outperformance over the last couple of months, it's really been semiconductors, and that's where we've been finding quite a bit of the idea generation coming from.
Absolutely. Let's pull up a chart of just that semiconductors index and take a look at that on an absolute basis, so we can see the industry group performance alone. There we go.
Yeah, so I mean, it's a totally different chart than what we were seeing on the S&P. You can see how we've had consistent go trend continuation icons throughout this sideways movement before now surging to new highs. And what that tells us is that generally speaking, the oscillators found support at the zero line, staying in positive territory. And that tells us that momentum has been in the side, or on the side, I should say, of the go trend. And every time we return to neutral territory, we've been generally finding support and then moving back, telling us that momentum is remaining with the trend. So that's what these trend continuation icons are telling us, that even though we're moving sideways, even though we're correcting, we're okay as long as we find support with momentum staying positive. And that's what happened. We saw that clustering of go trend continuation icons that we like to see on the second part of a correction. And then that led, of course, to new highs and strong blue bars. So a pretty strong chart if you look at it on its own of the semiconductors index.
Absolutely. And so, of course, we want to look down to the individual security level. Let's pull up a chart of NVIDIA, one of the largest holdings within the semiconductors group within the technology space.
Yeah, and that's a lovely looking trend. We can see that clean support being provided by the zero line on the oscillator. Strong blue bars, corrections being highlighted by the weaker aqua. But every time we come back to test that zero line, we find support. And that gives us these trend continuation icons. But you can see how we are racing away to new highs again on heavy volume. So, you know, we may be concerned, slightly overextended here. And if the oscillator pulls back, we're going to see a counter trend correction arrow. But right now, strong trend in place, oscillator in overbought territory. And we've just seen that break to new highs.
Fantastic. Now let's change the tune a little bit, right? We're not necessarily talking to just long-only investors. For those who are interested in the short side, let's pull up a chart of the XLF, the financial sector of the S&P 500, which of course has rolled over in the face of bank crises, runs on the bank, and collapses of Silicon Valley Bank and Signature. From this perspective, if you could even back it out a little bit, Alex, so that we could see a longer term view. In terms of the next area of support, right? There's still room to move lower before we reach those prior lows of 2000.
Yeah, not too much, but there definitely is some room down here below where we are at the moment. So we'll look out for some continued action lower.
Mm-hmm. And if we change this daily view to a monthly or even quarterly view, I think the point to pick out, right, as a relative underperformer for multiple years, the financial sector, you know, for technicians, it just hasn't been a leadership group since 2006. And so when we look at these charts on an absolute basis, we could see that certainly there were returns in the financial sector, but that's why the relative charts are so important, that we want to be holding leaders, not laggards. And then, Alex, within the financial sector, let's take a look at regional banks, KRE. Yeah. And if you could show that relative to the XLF. So I think what's most important here in this relative view, right? Regional banks underperforming the financial sector, which is not a leader of the equity markets on a sector basis. But we can see the risk management really clearly pop off the screen here. Even in that short window of the relative outperformance of regional banks against the financial sector in February, we saw that max squeeze build on the GoNoGo oscillator. So that tells us we've got a real tug of war. We see the range of price activity really tighten up in that squeeze. And then there's a decisive break to the downside. So we have negative momentum. We broke out of a max squeeze, telling us that on a relative basis, regional banks relative to the financial sector were serious underperformers. Then, right, so there's our leading indicator. Then the trend changes, and it changes many days before we saw any of the crisis or the headlines. And I think what's fascinating to me now, Alex, is that sort of the fears around the banking sector about contagion, counterparty risk. There's a lot of headlines circulating that are scaring a lot of investors and even analysts. But we haven't seen a ton of further damage from the regional banking ETF. And that is surprising, right? That we could have headlines day after day about the lack of solvency and the acquisitions of Credit Suisse and you name it. But we haven't seen a whole lot of further price action to the downside.
Yeah, it's found some support here at these levels. And it was a quick move, but you're right. Who knows where we'll go from here, but certainly consolidation at these levels. And we'll see what happens. But like you said, relatively speaking, a lot of underperformance from regional banks relative to the financial sector for quite a while. And then, of course, that complete to roll over. And even if you look at KRE on its own, you can see how that collapse was sort of not obviously we weren't told it was going to happen. But again, you saw the breakout of a max squeeze. And then you had a few days here in the no-go before that really rolled over. So technical analysis for risk management, I think, is sometimes not talked about enough. We talk about it in terms of what should we buy and what should we sell, but that kind of risk management approach is certainly very, very valuable.
And I keep coming back to the fact that the market knows all, right, Alex? Long before any of us are reading the headlines in Barron's, somebody knew what was lurking beneath the surface. And I think that the importance of not trying to predict or not scenario playing, but rather just reacting responsibly to what the market is telling us is going to help us stay out of trouble, protect us against those risk of ruin trades that really catapult our portfolio downwards. Alex, this has been a fantastic day talking with you. I'm sorry to all of our viewers that we didn't get this to you earlier today, but looking forward to seeing you every Thursday at 3:30 Eastern here on StockCharts TV. Until next week, be well, stay safe. We'll talk to you soon.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.